light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point.
Interest rates are going down, except with him, not too much. He did a rather, I would say, a rather small number that could have been doubled, at least doubled.
The Fed's rate cut falling short of President Trump's expectations. He wanted double what was delivered, and the meeting minutes reveal deep divisions over the move inside the central bank itself. Live from Singapore, this is Insight. I'm Haslinda Amin, bringing you the stories that matter with context and analysis that cut through the noise. Asian equities echo gains on Wall Street after the Fed rate cut. However, some disappointing numbers from Oracle have investors on edge again over AI-related spending. And speaking of AI, Amazon has snatched the spotlight in India with a pledge to invest $35 billion right after Microsoft committed to spend around $17 billion in the country.
We are committing to skill 20 million people across India in AI skills, and so we are very excited about this.
We speak exclusively with Microsoft's India and South Asia President Puneet Chandok on why the nation is becoming a new AI power base. And how will this feed through into the broader Indian economy? The government's chief economic advisor will be joining us exclusively to talk about that and the risk of not getting a trade deal with the US. Here's a quick check on the markets after the Fed delivered a quarter-point cut overnight. Stocks in the region echoing gains on Wall Street after the S&P 500 rallied to just shy of a record. Fed Chair Powell voiced optimism that the U.S. economy will strengthen as the inflationary impact from tariffs fades away.
Today, the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. Available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months. So I don't think that a rate hike is anybody's base case at this point.
Policymakers also maintain their outlook for just one cut next year, but details from the Fed meeting reveal just how divided the central bank has become. Powell faced dissenting voices in both directions, with regional Fed presidents from Chicago and Kansas City preferring to keep rates unchanged. Trump appointee Stephen Myron, meanwhile, dissented in favor of a larger half-point reduction. That's in line with the president's call.
The head of the Federal Reserve is a stiff, and, you fight that. It's amazing. We fight that, and yet interest rates are going down, except with him, not too much. He did a rather, I would say, a rather small number that could have been doubled, at least doubled.
For more, let's bring in our Federal Reserve and economy reporter, Anantha Nageswaran in Washington. And the cut today is more about protecting the job market rather than stimulating the economy. Is that a fair assumption?
That's right, Haslinda. Clearly the balance came down today about worries about where the labour market is, where it's going. And, obviously the committee is very divided about that, because we knew going into the Fed decision today that several policymakers were more worried about inflation than unemployment. Obviously, they did enough to get the balance across the line to push through this rate cut. What we didn't get, though, was any real clear guidance on where things go from here, because Chairman Powell did make the point that the interest rates are now probably at the higher end of neutral, perhaps indicating that they're on hold for a while, maybe not going to cut near term. But at the same time, he also made clear we're going to get a lot of economic data over the weeks and months ahead after a long lapse of economic data, which of course will inform their decision in terms of where we go in January. So next steps unclear, but what we do know in terms of from the dissents and from the forecast for where rates go from here in terms of the dot plots, there's a lot of division among the people who are on the Fed Policy Committee, and clearly some are more worried about inflation. And right here, right now, at face value, that would indicate further rate cuts from here will be difficult next year.
So divergent in terms of how many rate cuts can be expected from the Fed in 2026. The thing is, Powell seems quite confident about the outlook of the economy in the U.S.
That was quite a standout, actually, Haslinda. The growth forecast from September was really revised up, a material upgrade for growth next year. They're not looking at any material uptick in unemployment, according to the forecast for next year, and they're expecting inflation, core inflation, core PCE to start trailing down back towards their target over the coming years. So it's a pretty good set of forecasts. There were questions in the press conference around that. Why the urgency to cut now when you haven't had data, when of course you've been upgrading your growth forecast? What's worrying you? And this is where it comes down to the balance of risk, so to speak. Chairman Powell is making the point that clearly there's no risk-free path here. They see what's happening with inflation. They see what's happening with unemployment. They only have one tool and they need to make a decision, and that was the lever they pulled today. But clearly heading into next year, it's going to be a pretty complicated story if the data continues along the path that it is now, which is inflation above target and the labour market softening but not yet falling through the floor.
And thank you so much for that, our Federal Reserve and economy reporter Anna Curran in Washington. Let's get insights from Kenny Polcari, partner and chief market strategist at Slatestone Wealth, which has around $2 billion in assets under management. Bloomberg MLive strategist Mark Cranfield is also with us here in Singapore. Mark, let's start with you. It does seem that the Fed is suggesting it is safe to be risk on. I mean, what's the worry? The economy is okay.
Well, they're certainly helping to fuel it. Particularly this purchase of Treasury bills, $40 billion a month, is pretty substantial and earlier than the market was expecting. So that's a lot of fuel for people to play with. And as Jerome Powell was saying in the comments, this number is going to stay elevated, which suggests could even get bigger in the months ahead. This is almost like a return to a QE light kind of situation for the market, which only recently had quantitative tightening to cope with. So it's a dramatic change. So the Federal Reserve is really setting up a situation where liquidity is going to stay very buoyant in the United States. It will most likely help the US equity markets especially. Unless there's any big surprises on the AI front, it puts them in a very good position to at least get through year end and into early 2026.
Not just buying treasuries, but at elevated levels. I mean, why is there a need for that if everything is intact?
Well, they're concerned that as we get towards year end, sometimes you get a squeeze in the funding market. Sometimes there's not enough cash to go around. It's quite convenient as well because the US Treasury is ramping up its sales of Treasury bills quite substantially at about the same time. So somebody needs to take up that slack as well. So the timing from that point of view is quite nice. That will probably play out from a trader's point of view. That will probably be reflected in the curve. The Treasury yield curve will probably steepen as people need a bigger premium at the very long end of the curve, which is still going to see more sales of US bonds as well. So that juxtaposition will probably mean that people will be quite cautious about 30-year bonds in particular.
Kenny, what are you making of the messaging from the Fed? I mean, you know, we talk about how the Fed's expecting one more cut in 2026, but the dot plots don't agree.
Listen, I actually thought that Jay Powell was very clear today, right? He made it was a little bit hawkish, right? Which is what the market was expecting. He told us that the labor market was not falling off the edge. He told us that while inflation's higher than he wants it to be, above target, it might even tick a little bit higher, but then he sees it kind of retreating back as we move through 2026. He also commented GDP is expected to be growing at better than 2%, which is really the consensus. So quite honestly, I thought it was a great report. I thought he handled it well. I thought that he prepared the markets. I thought he was very clear. There's no rate cut in January, and I don't think there's one in March. But remember, I was in the camp that they shouldn't have cut anyway. I didn't want this cut to happen because I thought we were good where we were. But they made the cut. He made it also clear that there's 3 or 4 people on the committee that now think we're at that neutral level. I know, other than Stevie Miron, who wants to, take rates to 0, which is ridiculous, but that's a whole other conversation. But one way or the other, I actually thought it was a bullish report, and the market responded in kind.
But of course, it's still not good enough because Trump wants it closer to 1%. What changes might we see, perhaps within the FOMC, for Trump to get what he wants? And are you concerned about that?
I'm not, because it's not. If the data doesn't demand that if the economy is going off the edge, that's going to be a different story. But by all rights, up till today, with the data we have, the data that they're talking about going forward, the economy is not expected to be circling the drain. And so it's going to be very difficult to have to justify why we need to keep cutting and cutting and cutting, because the risk you run there, if you continue to cut, is that you're going to overstimulate, and then you're going to lose control of inflation. Just like we did, and I hate to say it, but I lived it, right, back in 1979, 1980, when they prematurely cut because they wanted to cut, and they ignited that monster, and it spun out of control, and then Paul Volcker had to jam rates and send the economy into a 2-year deep recession. I certainly don't want to see that. I don't think Jay Powell wants to see that. Donald Trump can stamp his feet all he wants, but it is a committee vote. It's not one person. So even if Kevin Hassett gets the job and he's a Trump loyalist, he alone cannot make that decision. And so I'd like to think that the other members on the committee that are all, Ivy League educated and PhDs and economists would use their head to say, we're okay. We're right where we should be based on the data we're getting. So I'm not necessarily worried that they're going to jam rates down to 1%. It doesn't make any sense to do that.
Is the U.S. really okay, Mark? I mean, the inflation target for 2026 is 2.6%. Bear in mind, everybody's getting a $2,000 paycheck, which eventually will mean, 1% of GDP. That's inflationary. And that is before we see the full impact of tariffs.
Well, we'd like to have a bit more data. We've been lacking a lot of up-to-date numbers from the United States because of the government shutdown. If you take purely the reading from the stock market seems to think that the American economy is doing pretty nicely, thank you. We're up not far from record levels from that point of view. American companies are still making very good profits. Oracle was a slight disappointment, but that's maybe just an isolated case. Most of the things that we've seen suggest the American economy is moving along pretty well, and there seems to be optimism that 2026 will be at least as good, particularly because the rest of the world is starting to come round as well. China especially is improving, which obviously will be reflected for the United States as well. So it does make you wonder, that you really need inflation to be really under control for the Federal Reserve to continue to lower interest rates in that kind of environment.
And Kenny, I'm just looking at reaction right now. We have the S&P 500 futures extending its drop to about 1%. What happened there? I mean, what's wrong?
Well, what's wrong is that we had this excitement today, where we're all at new highs on the S&P and the Russell and all that, making nice new highs here. But then we had the Oracle news after the bell, and I don't think the Oracle news is a disaster by any stretch. But all it speaks to is, once again, tech valuations that are stretched. You need one negative headline to talk about, the CapEx and the AI trade, and oh my God, are we overspending? And we're way ahead of ourselves, and you get this reaction. So I think it's. While I think the Oracle reaction is a little bit overdone, I'm not surprised that the market is reacting. We're seeing futures, NASDAQ futures specifically, down like they are on the back of that. Just because I think it's a valuation story. I don't think it says anything about the U.S. economy, the strength of the economy, or where we're going in 2026. And to Mark's point of view, the U.S. economy does feel good. It feels strong. It feels okay. We're not circling the drain. And so once again, unless inflation gets down to 2%, I don't see how they're going to cut rates any more than where they are.
It's okay until it's not. And because we're short of data, it's really hard to say. Would you be buying the dip, Kenny?
100%. I would. Now, here's the deal. I'm going to qualify it. I'm not chasing tech. I'll buy tech if we see a pullback, which I also expect is going to happen because we're going into a midterm election year. I fully suspect there's going to be some volatility in the first half of the year. I wouldn't be surprised if we see a 10 or 12% drawdown. At that point, I would absolutely be buying tech. But that doesn't mean I'm not buying financials, or I wouldn't be buying basic materials. I wouldn't be buying health. I would be buying healthcare, financials, basic materials, consumer staples. I would be buying all of those.
Buy the dip, Mark?
Well, I think people are getting a little bit concerned about this overspending on AI infrastructure. I think that's the biggest concern. We may be able to get past it. We've already seen some rotation into smaller cap companies, seem to be doing pretty well there. And the American market is enormous. There are plenty of other people apart from AI plays. But certainly there's a big concern there. And if we did see a widespread sell-off in the major names who are exposed to AI, it's not going to be easy for the market to progress beyond that.
So reason to be cautious. Slatestone wealth partner Kenny Polcari and Bloomberg M Live strategist Mark Cranfield will be staying with us. When we come back, we'll get insights on tech as Oracle's disappointing results stoke fresh AI spending fears. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. SoftBank shares are leading losses, while tech is the main drag on the MSCI Asia Index. As Oracle's earnings reignite fears over AI spending, it reported revenue that just missed analyst estimates, while posting a jump in capital outlay. That sent shares lower in late trade as investors weigh whether the increased spending may be taking longer to translate into revenue than earlier anticipated. Kenny Polcari from Slatestone and Bloomberg M Live strategist Mark Cranfield still with us. Kenny, let's start with you this time round. Why isn't Oracle perhaps a canary in the coal mine?
It might be. I mean, it might be, although I'm not in that camp, right? I think the AI story is very much in its infancy. I think it's going to, there's got a long runway. So while I think valuations might be stretched, I don't think it's a canary in a coal mine, meaning this is the beginning of the end. I don't think that. It might be the beginning of a pullback in tech, which would be okay. I'd love to see a pullback because I want to put more money to work. I'm not going to chase it at the highs. So it might be, but let's see. It might be just specific also to Oracle. Let's see how they start to digest it and dissect it tomorrow when everyone comes back and they get to, kind of chat about it and see where the problems really are. Again, I don't think it's a canary in the coal mine, but again, I think I'm not surprised by the reaction that they thought there was going to be $15 billion more in CapEx spending, more than what was expected. And so therefore, all the traders and the algos are going, oh my God, and they hit the sell button and this is what you get. But remember, Oracle had this massive move up in, where was it? When was it? September? Remember when it went from 240 to 350 in one day? It just gapped up. And then it's kind of been making its way. And then we had that pullback in tech stocks like a week and a half ago, and it came back down and it tested its long-term trend line support, where it's been kind of hugging right now. And today's action or tonight's action in the post-market or the pre-market tomorrow morning is going to bring it right down kind of its most recent lows here the last couple of days. So I actually think it's okay.
Hey, Kenny, Mark here. So we're talking a lot about the effect of American AI on the big American companies, but also they've got huge rivals in China as well. These big Chinese tech companies are taking AI in another direction. They're trying to develop their own tools. DeepSeek is one of the leading parts of that. So is this also a threat to the dominance of the American companies? If these Chinese companies really get traction and they can develop more and more onshore ability, is that going to weigh on the US companies, or are they going to generate together? Is it good for everybody if China and the US are doing well at the same time?
Well, I think it depends on your perspective, right? I'd like to think that it's a benefit, that it's a positive, right? There's competition, and so everyone, since there's competition, it'll all get better and better. Other people will look at it right away and say, "Oh, China's beating the U.S. in technology," and they'll see it as a negative. I don't see it as a negative that way. I'll actually see it as more of a competition and more of a positive. But I'm not necessarily sure, honestly, between me and you, that I believe really what's going on in China in terms of where they are and their advances that they're making. Just like that DeepSeek story that we saw in February of this year, and it turned out to not be what the headline first said it was going to be, and it created all that angst in the market, and oh my God, technology in China, they're going to kill the U.S., and none of that was true. And so I'm going to take this with a grain of salt. We'll see how it goes, but it's not going to cause me to start to get nervous about U.S. tech and our role in AI in the future.
Are you then saying, Kenny, you have no interest in investing in China's AI plays?
So that's right. I don't. I will not. My exposure to China are through companies like Apple. I won't go directly into China and invest in those. That's me personally. Now, as a firm, we'll invest in emerging markets through ETFs, not through individual names. And so we'll certainly, as a firm, will have some exposure. But me personally, I will not. I will stick with the European and the U.S. Technology names.
Mark, it does seem like sentiment has changed somewhat, right? In fact, some say perhaps fundamentally. It's a stage where we say, show me the money, because we want to see the returns. We don't want to wait any longer, and we're not seeing the money so far.
Well, anybody who's old enough to remember what happened with the internet boom and the bust in the late 1990s, 2000, they can remember the period when it was coming to monetize. So the dot-com thing started to unravel when people realized it was very difficult to monetize it. We're starting to get the early stages of that. Can we monetize AI? There's an interesting story today about Mark Zuckerberg. He's finally starting to shift into a place where he's going to try and have products that can capture some revenues specifically from AI. There's a limited space for that, and certainly there'll be a first user advantage. But there are many, many companies who are assuming they're going to build these products and they're going to be able to sell them and get big revenues. But the market is not going to be probably as big as they expect. A lot of people will be left behind. That's exactly what happened in the dot-com era. Too many people assumed that they would make money from it and they weren't able to sell those items. We could be into a similar situation, and that will bring down several people.
So we talk about how we need to be cautious, yet take a look at where the TAIEX is right now. It is at a record. Traders pretty much shrugging off and buying tech in Taiwan.
It's a bit distorted if you look at Taiwan because of Taiwan Semi. It makes up such an enormous part of that market, and foreign people tend to use it as a proxy for anything to do with AI and tech in Asia. If we get any downside to TSMC, that's not going to be good for the whole region.
Kenny, your final thoughts on the tech space. How would you be positioning for 2026?
So let me just say one thing about what Mark said. What I don't agree with about the dot-com bubble versus today is, remember, those dot-com stocks, those companies, they didn't produce real products. They were not changing the world. They were companies that had no revenues, no growth, no history. Today, you're talking about NVIDIA, Palantir, AMD, Taiwan Semi, all these tech names that are in fact producing real products, changing the world. So that's where I think it's different. I don't think this is anything like the bubble of 1999. Stretched, maybe. Bubble, no. Now, where am I positioning myself at 26? I said that we're into a midterm election year. The House is up for grabs, the whole thing. I think there's going to be a lot of chaos and commotion around new candidates, current candidates. What do they look like? Where do they stand on the scale? Are they far left, far right? Are they center? Right. That's going to create some short-term kind of angst in the market. So I suspect, again, that we're going to see the market pull back in the first half of the year. And that's going to lead me to want to be more cautious. Value names, industrial names, consumer staple names, financials. That's where I'd be. On a pullback, I am absolutely buying tech. Absolutely.
All right, great perspective there, Kenny. Thanks for joining us. Kenny Polcari, partner and chief market strategist at Slatestone Wealth, and Bloomberg M Live strategist Mark Cranfield. Keep it here with us. This is Bloomberg. welcome back. You're watching Insight. Bloomberg has learned that Indonesia is resisting U.S. trade deal demands that it fears would restrain its independence, particularly in critical minerals and energy. Sources say these sticking points could threaten Indonesia's ties with China and Russia. Let's bring in our Indonesia Deputy Bureau Chief, Claire Chow. Claire, it does seem like we're back to square one.
It does, and we're hitting a new step today, hopefully. Indonesia's top negotiator is meeting with U.S. Trade Representative Jameson Greer, so we will be watching out for that one. You know, publicly, Indonesia has said that negotiations are going fine and all the dynamics are as normal. But as you said, people familiar with discussion says it's actually getting stalled by several sticking points, and the major one is really critical minerals. And the problem is, back in July, the handshake between President Prabowo and President Trump really led to a very broad and, if vague, agreement between the two nations. And around critical minerals, wording was also very general about simply lifting export restrictions on these minerals. And now, what Indonesia is claiming is that the U.S. is trying to include new provisions in negotiations, which could include them requiring Indonesia to exclude any third party in any minerals cooperation. And now that's a problem for Indonesia because one of its, if not its largest partner in terms of critical minerals is China, and it doesn't want to compromise its relationship and its significant investment there. So we do have very tough negotiations ahead. For Indonesia, of course, it wants to secure that lower 19% tariff rate in what is its second largest export destination. But among officials, they also believe they do have a bargaining chip. They are the world's fourth largest population, and they're also the largest source of nickel, which is a very important critical mineral for things like EVs and batteries.
So it does feel like Indonesia is adopting China's playbook since it has that leverage when it comes to critical minerals. I'm just wondering, with Indonesia backtracking, is there a risk that the trade deal will absolutely collapse?
To be sure, there's still a lot of importance in Indonesia in securing this trade deal. The stance of Indonesia has always been it's not aligned with any specific country, but it will always put its interests first. And that means trying to secure whatever trade deal it can get with the U.S., but not at a point where it says it will concede or give up its economic sovereignty. It's hard to say if it's strictly aligning with China's playbook here. It has been willing to negotiate some sort of partnership with the U.S. It knows it needs investment from the U.S. to further build up its EV ecosystem. But whether or not that means it will come at the cost of billions of dollars that come from China is worth it, that will be the question.
Claire, great perspective there. Thank you. Bloomberg Indonesia Deputy Bureau Chief and Southeast Asia economy reporter Claire Chow there. Meanwhile, Washington's trade deals with Thailand and Cambodia could also be at risk as border tensions flare up. Over 500,000 people have been displaced as both sides exchange artillery fire, leaving at least 12 dead. President Trump, who took credit for ending the clash back in July, says he plans to speak to the country's leaders soon.
I was going to say that the Thailand and Cambodia are one of the 8 that I settled. They've been fighting for a long time. They've been fighting for a very long time, many, many, many decades. But I got along great with both. I found they were 2 great leaders, 2 great people, and I settled it once. I think I can do it pretty quickly. I think we're scheduling a phone call tomorrow.
Let's cross over to Bangkok and Bloomberg's Randy Thantongnaid. Randy, what's the latest here? What details do we have?
We're now 5 days into the worst fighting since July, and casualties are mounting fast. Thailand says 9 soldiers have been killed and dozens more injured, and Cambodia reports 10 civilians dead and around 60 seriously hurt. And I think this is exactly why Trump is stepping back in with the call. He's planning a call with both leaders, hoping to pull them back from the brink. And this conflict, although now has its own momentum, and a phone call, we'll have to see if they would have the same leverage as it did earlier this year.
What are the chances of an escalation? Because we don't quite know when Trump will be speaking to the leaders and how impactful that conversation would be.
The call could happen later today or tomorrow our time. This call matters because I think Trump has earlier tried tie this peace deal directly to tariff negotiations. And Thailand wants better trade term, but the renewed fighting could make the U.S. and the Trump administration question whether Thailand can stick to its deal. If Thailand doesn't show willingness to de-escalate this time, the U.S. could slow talks and add conditions or even hold back any tariff concessions. And Prime Minister Anantha of Thailand's tough stand may play well at home, but I think it carries a real economic risk for the country.
Is there a sense of who has the upper hand? Militarily, it's Thailand.
Yes, that's right. So Thailand has the upper hand here. We have an air force, fighter jets, which have been bombing Cambodia targets over the past 5 days. For Nussin himself, I think has been relying on the military to do its own thing, and it's a tricky balance because I think he's tapping into strong nationalist sentiment at home, and that could help him politically, especially heading into next year's election. But economically, as I said, Thailand has a lot to lose. The economy is already softening, tourism is weakened, there's flooding in the south, and his government earlier has been counting on this tariff negotiation to help with the recovery with the export-driven economy. So, now playing to domestic politics could hurt that chance.
Randy, thank you. Randy Thantong Knight in Bangkok. Let's get greater perspective. Erik Martinez Kuhonta, Associate Professor at McGill University. Erik, good to have you with us. How would you characterize this renewed conflict?
Well, it's pretty severe. It's a significant escalation from the July conflict, and based on the actual military engagement as well as the rhetoric, this is quite significant, and I don't think that a solution is that clear given the very heightened state.
So what can be done? How much can Trump achieve? What do you make of the upcoming talks with the two leaders?
Yeah, well, Trump is invested in trying to find a solution here because, as we all know, he's very much intent on this Nobel Peace Prize. And in the past, in July, when you had a 5-day war, in fact, Trump was instrumental in helping to bring that conflict to a cessation. So he will get involved again, but I think this time is somewhat different. It's different because Thailand has made clear in their comments by the foreign minister, by Anutin, that they are not in the mood for dialogue, and that they do not believe that the peace agreement really is something that was intended to hold. In November, they already pulled away, and the trade talks had already also pulled away from the U.S. And despite that, Thailand continued in saying that peace was not in the future, was not in the offing. So it's going to be difficult to solve this.
So are we anticipating an escalation in tensions in the conflict between the two sides? And if that is the case, is there anything ASEAN can do?
Yes, for sure. ASEAN is going to be an important player here. And Anwar has already made it clear, and even Singapore has made it clear that they want to find a basis for dialogue. So even in July, ASEAN was important there, and it is ultimately the key regional body that is most deeply invested in ensuring that there is stability in the region. Now, I think this. My guess is that this will play out still for a few days because Thailand seems to want to. The Army Chief of Staff has said that they want to paralyze the Cambodian military. So Thailand is using very strong rhetoric at this moment. But ultimately, ASEAN and UNRWA has to find a way to get the two parties to speak, and there has got to be some concession somewhere along the road. A big sticking point for Thailand is the question of landmines, and they have made a case in Geneva at the United Nations that there should be an international fact-finding mission to understand where these landmines are coming from, and that will clearly be a sticking point in any future negotiations.
It sounds like it is a valid proposal from Thailand, do you think? I mean, is there merit in what they're proposing? And is there a way of getting the ICJ involved in this? The International Court of Justice, could it play a part in resolving the situation?
Yes, well, in terms of the landmines issue, the Ottawa Convention on the banning of landmines, so Thailand has raised this last week at the United Nations in Geneva, and what they're asking for basically is an international fact-finding mission. They have a strong case, and there has been an ASEAN mission ready that looked at landmines and was of the view that these were new landmines, which is the case that Thailand has been making. So there, Thailand has a good case. On the issue of the ICJ, on the other hand, that has ruled in the past in 1962, but also more recently after the conflict in 2008, 2011, has ruled against Thailand on the question of the demarcation of the border. So in terms of the ICJ, the International Court of Justice, Thailand generally doesn't want to go in that direction and prefers to solve issues at a bilateral level in terms of the border itself, because the International Court of Justice has sided with Cambodia in the past.
What do you make of Thailand's hardened stance on the conflict? Is it just leverage that it has militarily?
Yes, I mean the leverage militarily is central to its rhetoric, its tone. That is for sure, and Cambodia itself is portraying. Cambodia is then. And the inverse, portraying itself as a victim to the stronger power in this conflict. But the issue also, beyond the armed capacities and the strength, the leverage of Thailand vis-a-vis Cambodia, is also nationalism. And here, both Cambodia and Thailand have a strong nationalist sentiment that is kind of roiling things up. And that's driving also the momentum of this conflict.
You get a sense that there'll be no resolution anytime soon. Might there be implications on regional stability?
Well, I mean, this conflict shouldn't go beyond the Thailand-Cambodia border area, which is basically the northwest of Cambodia, or the northeast of Thailand. It shouldn't go beyond that specific area and the rupture of relations between Thailand and Cambodia. But in terms of, say, cultural events, Cambodia has already pulled out of the Southeast Asian Games, so that is indicating that this conflict has had consequences for athletes, for sporting events, sporting and cultural events. On that level, yes, it has expanded. But in terms of the wider region, the wider geopolitical aspects of the region, there should not be a reason for this to go further.
This is, of course, a region where the U.S. and China are trying to gain greater influence. Might this crisis, might this conflict lead to a broader proxy competition between the U.S. and China? Might that come into play at some point?
Well, I'm not sure that it would necessarily follow from this conflict. Right now, the U.S. has indicated that its own interest in this conflict is in solving it. as opposed to gaining a more direct kind of security gain from this. And China itself has also spoken about trying to find some solution to this conflict as well. So there's no indication that either of these great powers intends to use the conflict or Thailand or Cambodia's position specifically to advance its particular geopolitical interests. I think in the big picture, there's very little to gain from geopolitically from this conflict. Rather, what is to be gained from this conflict for the warring parties is nationalist domestic support that tends to get ratcheted up when you are fighting with a rival neighbor.
So talk to us about the support both countries are getting at home. I mean, there are casualties in this conflict. How are they viewing that? And I guess, how much pressure are they feeling at home?
Well, in Thailand, this is this kind of conflict. This is already clear in July. It's clear. It is also abundantly clear now, based on the rhetoric. This kind of conflict tends to have, at least in the short term, benefits for the government, because it tends to rally the nation, and there's also a strong current in Thailand that is very nationalistic, very supportive of the military. Anutin, the prime minister, the leader of the Boonchai Thai party, a conservative individual, and he's also made clear that he has granted the military the certain amount of autonomy in making decisions on the question of the border and the conflict. So in that sense, in Thailand, there is no question that this could have short-term gains in terms of nationalist sentiment and national cohesion. For Cambodia, you have a similar dynamic in the sense that Hun Manet, the prime minister and the son of Hun Sen, is still trying to, in some sense, anchor his power base. And Hun Sen, obviously the dominant figure of Cambodia. So this kind of conflict also helps to rally the nation behind an upcoming leader. So on both sides, there is no question that there is a nationalist surge that supports the leader who is at war with another country. But on economic terms, and in terms of the people, of course, affected at the border, and we're talking about 500,000 people who are being displaced, this is obviously very, very detrimental.
Erik, thank you so much for that assessment. Erik Martinez, Kuhonta, Associate Professor at McGill University. And there's something to tell you about when it comes to that 20-year bond auction in Japan. Japan's 20-year bond sale drawing the strongest demand ratio since 2020. A 20-year bond bid cover ratio of 4.1 versus a 12-month average of 3.28. It does seem like there's been a lot of appetite for those JGBs. We saw the same kind of strong demand for 10s and 30s auction that we saw in the last several weeks. Still to come, in an unprecedented move, India's aviation regulator deploying on-site teams to monitor operations at IndiGo's corporate office. We're live to New Delhi for the latest. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Let's do a check on Indian markets. Been trading for about 6 minutes now. If I have to hazard a guess, yes, it is tilting towards positive territory. The Sensex up about 0.1%. Again, it is about the rupee trading versus the USD. Currently, it is down about 0.1%, breaching that 90 level that we have been tracking. We're also keeping an eye on IndiGo shares after India's aviation regulator deployed 2 on-site teams to its corporate office to monitor operations. IndiGo board chairman Vikram Singh Mehta has issued an apology after the airline triggered massive travel disruptions last week by cancelling more than 3,000 flights.
I know
an apology cannot make up for missed events, long waits, or the stress many of you have experienced. But it is important for me to express our regret and acknowledge the disruption you have all faced. We did not meet your expectations during those days, and for that, we are truly, truly sorry.
Let's get to New Delhi. Bring in Bloomberg India aviation reporter Mihir Mishra. Mihir, what is the status of IndiGo's operations now?
Hi, good morning. So the status has kind of the operations have kind of stabilized. IndiGo is in control of its operations. They are able to operate flights. The on-time performance of flights have improved. So operations have stabilized, but the real issue now is the regulatory actions that are going through, in the sense that these regulatory actions have reached IndiGo's headquarters now. There will be a lot of scrutiny of their numbers. That clearly will take a lot of bandwidth of the management. Now the operations, while they have stabilized, the focus will not so much be of the top management on operations. So that is something the top management will have to balance going ahead, operations as well as regulatory questions that may come going ahead.
So what are we paying particular attention to when it comes to that regulatory scrutiny that's being imposed on IndiGo?
Okay. So there is a view within the government and India's regulator that this particular crisis, wherein thousands of flights were cancelled, was kind of engineered. This is a view that it was engineered by the IndiGo management just to get some sort of a reprieve from the pilot rest rules that they had announced and which had come into effect from 1st of November. If you listen to Mr. Mehta's statement yesterday, he did clarify on that bit, saying that there is no such engineering done by IndiGo that would have impacted their operations.
And Mihir, what's been the reaction from the aviation industry as a whole, especially when we're talking about more than 3,000 flight cancellations?
Yes. The Indian aviation industry, what goes ahead now, IndiGo has restored its operations, so they are operating about 1,900 flights a day, as against 2,200 daily flights which they used to operate. Now they'll have to cancel some 210, 20 odd flights. This is the regulatory action. Now once they cancel those flights, the other airlines have been asked to pitch in with flights to ensure that the deficit in capacity is being met, so that the impact of fares as we enter the peak holiday season is not that much. So there is a meeting between other airlines and the government and the regulator also today, wherein they will discuss a plan from rest of the airlines as to how do they want to fill in the space that will be created with IndiGo's flight cancellations. Thank you.
Bloomberg India aviation reporter Mihir Mishra, thank you. Still ahead on Inside Vantage Markets tells us what they think the Fed's rate cut flips the 2026 playbook towards growth. Microsoft's India president will be joining us to discuss their pledge to invest $17 billion into the country's AI sector, and an exclusive with India's chief economic advisor. Plenty more ahead. This is Bloomberg.
Cuts would actually concern me, because that would imply that the economy is weaker than we presently see, considerably weaker. it can happen, but I think it would say some things about overall economic growth that would not be a happy situation.
I think what's key to the Federal Reserve is that they want the yields to come off, right? And if you look at the 10-year yields at 4.13%, that's actually a little bit too high and a little bit higher than what they're actually really comfortable about.
We will see into 2026 traditional opportunities or avenues for income tail off a little. And then when we think about how the market's actually done so well this year as well, perhaps a narrowing of the opportunity set for alpha as well.
Some of our guests today sharing their thoughts on the Fed's rate path. Welcome back. You're watching Inside. Let's do a check on how those crosses are doing on the back of the Fed's 25 basis point cut. We've seen dollar weakness. Currently, dollar index is stabilizing on the back of the weakness that we've seen so far. In terms of the Japanese yen, of course, this is one currency front and center. Amid expectations, the BOJ will raise rates in December. We're seeing the dollar weakening versus the JPY, in fact, the GPI strengthening by about 0.2%. In terms of that cross with the yuan, it is flat as we speak after the dollar yuan headed towards 7 just earlier, and the Aussie dollar also in focus, 66 versus the greenback as we speak right now. Well, for more, let's bring in Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu. Stephen, if you consider that the Fed is expected to cut further in 2026, expect dollar weakness from here.
Well, in fact, we have the view that the dollar may be quite strong early next year, quite counterintuitively against the Asian currencies. And the decision overnight, you can call it neutral, some call it dovish. But the takeaway is like the Fed now is still only committing to one cut next year. And market is pricing for two. And even with two cuts, U.S. interest rate will still be relatively higher compared to a lot of the Asia low yielders. So if you ask me, I actually like dollar Asia upside, especially when you look at the Korean won, the Taiwan dollar. After some initial rally earlier this morning, it's starting to come off a little bit. So market basically is telling you that it's not all clear for Asian currencies upside, despite a somewhat dovish Fed overnight.
It's also about the yen in particular, with the BOJ expected to raise rates. How are you looking at that cross?
I mean, when we look at the yen nowadays with the new government, we have to look at it differently. It's not just about monetary policy differential. It's not just about rate differential. It's also about the fiscal prospect of the yen. So very simple, we look at the JGB yields is still selling off. So that tells you that despite of higher yields, despite BOJ could hike rate further, the fiscal concern is still one big driver for the yen. So if you ask me, I think there's only some little bit of downside for dollar yen. And when the yields start to sell off again, then the yen will also weaken further.
We heard from State Street when it comes to yen appreciation. They said perhaps we'll see a minimal move because when it comes to rate increases by the BOJ, it could be much smaller than anticipated.
Exactly. So even if the BOJ is hiking, we're only talking about 25, 50 max. And as long as the Fed doesn't cut rates aggressively, if it's only like 1 to 2, that's very moderate. And the US-Japan rate gap is still pretty high, so it's very hard to short the yen at the moment. So if you ask me, I'm not that bullish about the Japanese yen for next year.
And Stephen, the yuan, prospects for that currency in 2026?
Well, in fact, it's my favorite currency if you ask me. I mean, it's not based on the fact that it could rally the most. It's based on the fact that it has so many structural tailwinds from short-term to long-term that regardless of whether the dollar is strong or weak, the yuan could still appreciate against the dollar. And I think the bottom line is it could rally beyond 7 because we saw there's the trade tailwinds. Now FDI is getting better. And then obviously the latest statement from the Central Politburo, they mentioned about the cross-cyclical focus, meaning that they want a stronger currency to bolster domestic consumption. So it's all good for the yuan for next year.
We haven't seen that so far, though. PBOC policy seems to indicate that it is quite comfortable where the yuan is right now. Stephen, thank you. Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu there. Our next guest believes economic strength and improved liquidity will be the main drivers for the Fed. Let's get insights from Hebe Chen, market analyst at Vantage Markets. Hebe, good to have you with us. What messaging have you been paying attention to when it comes to the Fed overnight?
Yes, indeed. Good afternoon. Thank you for having me today. Well, I think we do have a big pack of message coming from Fed today. And I all have to say that what surprised me most is the economy projection. I feel the Fed seems to present us a story. I would say it's a bit close to too good to be true. They actually reduced the expectation for inflation. They only see a 2.4 versus 2.6. And most importantly is they increased the GDP growth target for next year from 1.8 to 2.3. That's a 0.5% increasement. So regardless of where they got the confidence from that for the economy strength, I think that what suggests to me is that when we're heading into 2026, I think the playbook will be very, very different. The topic about rate cut cycle will probably be taking the secondary place, and what we're taking the main theme about 2026 is an economy that's gaining speed. It potentially will be a new speed. And how we're going to tailor the trading strategy, how we're going to check the monetary policy, they will change quite significantly based on this new playbook.
It's hard to square the picture that Jerome Powell is painting for us right now. He talks about how the economy is resilient. He's pretty confident of solid growth. Yet he continues to inject liquidity into the market. I mean, how are you making sense of all the moves that's been announced so far?
Yes, indeed. I would say that it's a bit, I think the message is a bit confusing here. But I think the market they're very smart traders. They do get the message. I think the thing that sort of boosts the market quite substantially is the 40 billion T-bills purchase. As you said, that definitely will inject liquidity in the market. Even the Fed saying that it's a temporary, they don't want to call it as a QE, but effectively, they will serve the same thing. We have the more liquidity here. We also have the Fed saying that we yet to done the rate cut cycle, even just one, or probably some traders expecting two, but we definitely will get one cut next year. So if you're putting all together, it's effectively serve the same purpose as the QE. And I think that's also what the Fed also priced in the economic projection. Because of all these things they're putting in place, they are now expecting the economy will gaining the speed and will definitely perform much better than 25.
And Hebe, given the liquidity, given that the Fed has signaled it is providing that backstop should anything happen, it is risk on. You should be buying American stocks, U.S. stocks, yes?
Well, as I said, that now the story is now back into the economy growth, is back into the economy strength. That doesn't come with no risk. I think that what the focus will definitely get into, not just about how much rate cut that will be in place, it's about how strong the economy could be. So that would mean that translate into some of the particular data will definitely carry more rate. For example, the job data, that's a testing point for whether or not economy is as resilient as a Fed promise. On the other hand, I think I agree that some of the sectors, which is probably more economy-sensitive sectors, like technology sectors, were definitely getting more spotlight under this preset economy backdrop.
Other central banks, especially in Asia, are taking a different approach, right? I mean, there's divergence. We expect the BOJ to raise rates. And a lot of the central banks in Asia are either pausing or could consider rate rises. How is that influencing, shaping the way you deploy capital for 2026?
Well, yes, I think that 2026 is the time that we're going to see very different paths. It won't be the one that we have seen in the past 3 years. I think, for example, not just the Asian, that RBA is now anticipate to increase the interest rate. Japan, as you mentioned, is pretty much likely to increase interest rate by the end of this month. So I think what they're showing is that we potentially won't see the lockstep for the in between the different central banks, which definitely will translate into the different strengths of the currencies. I kind of agree with Stephen just mentioned about that U.S. dollar potentially will getting more stronger into 26, but I think that will potentially not coming from rate cut, but because of the economy is strong. When they translate into the Asian currency, I think that will definitely become a checking point is whether or not the economy could stay strong. They could keep the pace on. And the central bank do have the confidence to support the economy. We do see the Central Bank of India, for instance, they're also actually taking an extra step there to ease the interest rate. I think that's sort of reflecting a very complicated picture when the inflation becomes not the major concern. Now the central bank have to focus on the economy growth now.
I want to take a look at Japan. Of course, the BOJ move pretty much priced in. The question really is where it goes from here. Is it one and done? Will we see more? What's your own projections?
Yes, indeed. I think that's the key message that we're waiting for end of this month, the meeting. I think that in terms of the whether or not they are ready, I would say the 100%. I think the Bank of Japan, inflation has never been a big hurdle for Bank of Japan to increase their interest rate. Inflation has been above 2% target for the past 3 years, not just this year. And the recent pickup is only about 3% in last month for the Japan. They also tick all the boxes. What they actually hold them back cautiously is more about the political noise. But now sitting at the end of this year and moving into next year, now the political noise, the new PM seems to settle. Japan Central Bank got a more clear picture about the economy policy moving forward. I think it's definitely good timing. And what, as you mentioned, that what could definitely move the market is whether or not it's one and done, and whether or not they will keep their cautious move into next year, or they're saying that, oh, we're officially starting a new cycle of the tightening. I think that would definitely make a huge difference to the market movement. And the important thing is, if you're looking for Japanese yen and the Nikkei, the market has already seems to prepare for the both scenario.
Well, I suppose public debt is one risk in the Japanese market. It is 230% of GDP. How are you assessing that risk?
Yes, I agree. I think that's quite a major reason. That's probably one of the reasons that the Bank of Japan is still taking cautiously. And that don't forget that because of the new leaders of Japan, they're going to likely to boost the economy with more of the government spending. I think that's definitely an underlying risk, which potentially will surface as one of the critical risks into 2026. So if they're considering that, I was still expecting the Bank of Japan will taking an extra cautious tone, even it's a rate hike and potentially will be a dovish hike for this month's meeting.
Hebe, what's your yen target for the end of 2026?
I think that at this stage, it's roughly about 155 USD versus Japanese yen. I think two scenarios. If the Bank of Japan taking a bit hawkish, saying that we will keep the door open for more hike, I think potentially we're seeing the yen back into even below 150 by the end of this year. But if that's not the case, they will stay cautious. I think very much likely they will stay at this stage until into 2026. I think one of the patterns we probably can reference to is how the yen then moved in early January when the Bank of Japan moved the interest rate.
And Hebe, we heard earlier from Stephen Chu that he loves the Chinese yuan. He says there is a lot of scope for upside for the currency. Do you share that view?
Well, I have to say that I kind of disagree with that, because I do expect that PBOC will potentially cut interest rate into 2026. And the reason for that, I know that the inflation print this week is positive, showing a bit of a stabilization for the consumption. But you got to seeing that whether or not the underlying demand that do support a sustainable recovery. And unfortunately, I think for some of the economy data, I didn't see that it's coming, especially like a PPI. The producer prices still stay in negative area for the past 3 years, and it is also dropping about 2.2% from last year. So showing the demand side, I would say that it still stay quite extremely weak and fragile. So from that perspective, I don't see that PBOC is now time for them to feel that they are happy with the inflation, they're happy that the deflation rate has gone. Apart from that, I think the Chinese the policymaker will be very cautious about the appreciation of the yen, because the export and import surplus is getting into a record high level. So they will definitely be extra cautious about the yen once they get into a very dangerous level, like Stephen saying that they will potentially pass 7. I think that will be a more of an alarm to the policymaker rather than something to welcome and happy about.
To your point, a weak currency, a weak yuan would help Chinese exports. That seems to be one of the bright sparks for the Chinese economy. It does serve China well if it keeps its currency weak, doesn't it?
Yeah, but in the other sense, if the Chinese currency appreciated, they will seems to getting the weaker export. And we know that, as we mentioned, the PPI, the whole demand, either from domestic or from the overseas, is getting to a pretty weak level. So they probably won't take a risk to seeing that a quite big chunk of the demand from overseas is getting weaker as well. So I think that's sort of the balance act that definitely have to be very careful about.
Hebe, before we let you go, what are your best bets for 2026?
Well, I think that the 2026 will be the time for relocate your assets. So as I said, that we're now getting into a different cycle. We're moving from a rate cut cycle to the economy boosted cycle. So either the economy sensitive sectors were definitely the one. On the other hand, I think there's still a lot of uncertainty and risk there. On that side, I would still recommend to keep a big proportion in the safe haven to sort of balance the risk in there.
Hebe Chen, market analyst at Vantage Markets. Thank you for that. Coming up, Microsoft's India and South Asia president shares exclusive insights on the company's pledge to invest $17 billion into India's AI sector. This is Bloomberg. You're watching Inside. Microsoft has revealed more details about its big bet on India's AI ecosystem. The tech giant earlier pledged to invest over $17 billion in AI and cloud computing in the South Asian country over 4 years. During a speech in New Delhi, CEO Satya Nadella said they will also double their skilling initiative.
We are committing to skill 20 million people across India in AI skills, and so we are very excited about this.
Joining us exclusively now is Puneet Chandok, Microsoft India and South Asia president. Puneet, good to have you with us. Talk to us about this optimism in AI in India. What's driving that?
Thrilled to be here, Haslinda. Thank you for having me. India is today at an extraordinary moment. India has proved to the world that what a nation can do with digital public infrastructure. And now India is at the beginning of something even bigger, with its leap into an AI-led future, emerging truly as a frontier AI nation. And this investment from Microsoft will make us the largest hyperscaler presence in the country. It is more than capital. It's a signal that there's a next chapter in India's AI ambition, population scale impact coming, and we're going to advance infrastructure. We're going to skill 20 million people, as you said, by 2030, and also build sovereign-ready solutions to drive inclusive economic growth in the country from the length and breadth of this country and make it AI first.
So the idea is to scale. Give us a sense of that scale. Where would your data center footprint be by 2029?
So already by middle of next year, by middle of 2026, we'll have the largest hyperscaler presence in the country, 4 data center regions. Plus, we've got a partnership with Reliance Jio, so there are 2 data center regions there. So 6 data center regions across the country, which gives us incredible scale for India first businesses to build. This is secure, sovereign-ready hyperscale infrastructure. Plus, we're scaling people in millions, as you said, and then also strengthening the ecosystem with partners, with customers, with startups, with small and medium businesses, with the government sector, and really bringing all of this together.
Presumably, Puneet, you're going to need more headcount, right? So how many more? What's the hiring plan? How many more engineers do you think you'd need?
We already have a really large presence with 22,000 engineers in India. We're building on it. We're investing in areas where we need more AI capacity and AI capability. So constantly looking for talent, constantly investing in areas where we see more demand from customers, and constantly building in India.
Is there a number you can put in the next, 2 to 3 years? How many more headcount do you think you'll be adding in India?
I wouldn't put a number on this, but again, working backwards from customers, partners, government, and the demands in this country, which is, by the way, significant given our AI ambition in the country, we will continue to invest, Haslinda.
Microsoft has talked about how it will reskill, upskill the workers in India. Where is that skills gap most prominent, you think?
No, Haslinda, at the end, this is a question I get all the time, which is, would AI steal jobs, right? And I don't think AI will steal jobs. AI will dissect the jobs. They'll unbundle the jobs. Your job is a bundle of tasks. My job is a bundle of tasks, right? And once the jobs get unbundled, we'll have to bundle ourselves much better. So how do we make sure people have the AI tools, the AI, like AI literacy, AI fluency is the new literacy. How do we make sure that they're learning how to use these tools? How to make these tools move from a tool to a teammate? How do you really get AI to work with you, along with you, like a digital colleague? Those are the areas where we're going very deep on training and skilling. We're working with the government of India on something called eShram, which is 300 million unorganized sector workers in the country, bringing them on one platform, helping them with AI to build resumes, skills, areas to go deep into, and then creating employment opportunities, right? So it's an end-to-end value chain of skilling, making sure there are career opportunities, and then getting people to be successful at what they do.
So it is an AI-first future for India, right? That is what they've been talking about. How does that look like in the end, in 5 years from now? How might that change India? How will it look like on the back of that strategy?
So India is doing two things, Haslinda, which is fascinating, and it's an example for the world, right? One is India is laying the tracks before the rails, which is with AI infrastructure. So we've got 7 digital highways, as I call them, the biometric system, the unified payment interface. All of those are digital public infrastructure that allows India to move really fast. And now India is moving that digital public infrastructure to be AI ready. We've got 22 million developers in India, which is one of the largest populations in the world. And these developers are taking that digital public infrastructure to make it AI ready, right? That is the shift that's happening in this country, which is fascinating. And then Indian customers from healthcare, like Apollo, which is building a co-pilot for clinicians, for doctors, to make doctors more effective, to Narayana Health, to Air India, which is completely reimagining the customer experience, your bookings, your changes, all of your tickets happening through an agent which is multilingual, which is helping you do all of this seamlessly, right? So customers are adopting AI at a scale which is fascinating. The country is moving on digital rails and building AI infrastructure. And then we're diffusing technology at a very fast clip from classrooms to boardrooms, right? So that's the flywheel in India that's starting to turn really fast, Haslinda.
All coming at a time when there are concerns about that H-1B visa imposed by Trump. I'm just wondering whether that's shaping the thinking about, how best to invest in India, how best to capitalize the Indian market.
So listen, India is the talent capital of the world, the youngest workforce of the world, the most interesting startup ecosystem. Scaling is happening on steroids and scale, as I said. So there is a lot of talent that's being skilled and made ready for the AI future that India needs. Indian consumers, Indian businesses adopting AI. I think that's where I'm really excited about, Haslinda, which is how do we match the demand that's coming from customers and enterprises and government and get the talent ready. I think that's what we're doing. And then also India is building for the world, right? I mean, you spoke about India as the largest captive capital on the planet now. Most large corporations have captive setups. We have the largest IT service providers. We have the largest product companies. We have the largest startups coming up. So I think it's a very bright future for India, given both the demand side, the diffusion that's happening, and also the talent that is now being scaled like never before.
Puneet, thank you. Puneet Chandok, President at Microsoft India and South Asia. Still to come, analysts expect a tick higher in Indian inflation when we get the November numbers tomorrow. We'll speak exclusively with the Modi government's chief economic advisor about the rates and growth outlook and whether they're any closer to that elusive trade deal with the US. This is Bloomberg. You're watching Inside, and we have headlines coming through. China responding to that proposed tariffs on its goods. China saying that the proposed tariffs, it is opposed to all the tariffs being imposed, all forms of unilateral tariffs, it says. It is monitoring the impacts. It's urging Mexico to correct that unilateralism quickly, to correct its mistakes and to correct its wrongdoing. And it says that any trade agreements should not harm China's interests. Again, China responding to the tariffs being proposed by Mexico. Now, speaking of tariffs and trade, U.S. and Indian officials have begun talks aimed at resolving differences and finalizing a trade deal. New Delhi says discussions touched on economic and technology partnership, as well as opportunities to boost trade and resilient supply chains. The two countries have been working on an agreement to address President Trump's 50% tariff on Indian goods. And yesterday, we asked HSBC chief India economist and strategist Pranjul Bhandari about the trade talks and the potential impact on growth.
We had a lot of fiscal expenditure, both by center and states, which was done upfront, which could slow in the first quarter of 2026. So my sense is, yes, growth could slow a little bit, but I also have a base case view that hopefully by March we'll get a trade deal done, which will not just be good for exports, but also for sentiments. And then, towards the middle of the year, things could start to bounce back up again.
Joining us exclusively, Anantha Nageswaran, India's chief economic advisor. Van, good to have you with us. Of course, it's hard to tell when that trade deal might come through. Any sense, any inkling you can share with us?
Thank you, Haslinda. Good to be back on your show. To be honest with you, right now it's very difficult to put a timeline to it because we all know very well by now, I think, through multiple rounds of conversations, most of the trade-related issues have been sorted out. And therefore, I believe this is as much a matter of geopolitical developments as it is a matter of bilateral trade issues. So that's why it has become difficult to give you a timeline on this, Haslinda. Back to you.
It remains a big question mark for markets, for investors, for economists. They're tracking that deal really closely. If there is no deal, even by the end of this year, what implications are there for India's economy, you think?
Well, I mean, this year we have only about 2.5 weeks or so to go. So I think, as you played a clip of your conversation with the Pranjul Bhandari, I think, like her, I would also be surprised if we don't have one lined up or sealed down. I'd be surprised if we don't have a deal sealed by the end of the financial year. I was anticipating that, I was hoping that something would be done by end of November, but it has turned out to be elusive. I agree with you that it has had an impact on investor sentiment. And as and when the deal is sort of agreed upon, and definitely there will be a huge sort of a weight lifted off the shoulders of the Indian market, so that risk premium will dissipate. So that is for sure.
How is that uncertainty playing and shaping into how you look at the budget for 2027? I mean, what are your key considerations when it comes to that?
No, I mean, obviously, trade uncertainties do play a part in how we project the GDP numbers. But nonetheless, I think, as you may have been noticing in our data, the domestic economy is doing rather well, and the exporters themselves have been able to withstand the effects of the tariff and partially offset its negative fallout by diversifying into other markets. There is no gainsaying the fact that it has had an impact on specific sectors, and they are significantly, affected. But nonetheless, considering the kind of fears that they entertained back in August, I think their own resilience has come out rather well than before. So as far as we are concerned, I think we are quite positive that the underlying economic momentum in the economy will support economic growth outlook for 26-27, and thus underpin our revenue, fiscal deficit numbers, etc.
The question is how strong the Indian economy will grow in 2026. We saw pretty much better than expected GDP, especially for the first half of the year. How much momentum, how well supported is that? Or is it a one-off?
No, I don't think it's one-off. If anything, I would rather argue that we are beginning to see the lagged and the cumulative impact of the various structural reforms that this government has undertaken since 2014. The investment in public infrastructure, the massive rollout of the digital public infrastructure, and then other structural reforms like GST, insolvency, bankruptcy code, and the continued sustained efforts to bring small and medium micro enterprises into the formal sector of the economy. If you put them all together, I think we are beginning to see a certain impact on potential growth rate, and we are waiting for the new base year revisions and methodological revisions to be rolled out in February, March of the coming year. Then we will be able to get a better handle on the potential growth numbers. But my gut feeling is that India's potential growth has moved higher on account of these decade-long structural reforms. So it is not a one-off thing. I expect it to sustain in 26-27 financial year.
Yet, the RBI says you can expect India's growth to soften somewhat. How do you read that? Or do you disagree?
Well, I mean, RBI has... I'm sorry, go ahead.
Do you disagree?
No, I don't disagree. I mean, in the sense that RBI has revised its growth forecast for the current financial year to 7.3%. Its estimate, rather than forecast at this stage. So the growth estimate for 25-26 is 7.3%. And therefore, for the next financial year, they are predicting a number that is around 6.7% in real terms. I mean, that's kind of understandable because of the base effect and so on. So at the same time, every year in the last 5 years post-COVID, the economy has surprised us with better good performance than what we anticipate early in the forecasting cycle. I will not be surprised if something like this happens for 26-27 as well.
How about consumption, Van? How strong is it? We know that it's been well supported by the GST reform, but some say that impact, will ease going forward.
Well, not really. If anything, I would argue that the consumption story will become stronger, particularly in urban India. It is very well documented right now that rural consumption is actually faring extremely well on the back of successive good monsoons, on the back of real wage growth, income growth in rural India. Agricultural production is doing well. If anything, as you can see in the sustained decline in the uptake of the National Rural Employment Guarantee Program, it is very clear that rural residents are finding employment opportunities elsewhere, that they don't have to fall back on the national government-run Rural Employment Guarantee Program. And that is the clearest possible indication that rural economy is in very good shape. Urban India, of course, I think the GST cut, and we should not forget the direct tax relief provided in the budget earlier this year, and the fact that inflation itself, particularly food, which constitutes about a third or slightly more of your monthly consumption basket, that is low. So putting more disposable income in their hands as well. And that is the reason why India's household savings rate, which went to as low as 4.9% of GDP in 22-23, has risen to 6% of GDP. Financial liabilities have come down in absolute rupee terms in 24-25. So all of the commentators who were quite concerned about the declining household savings rate haven't covered the improvement in a material improvement in the household savings rate as much as they lamented its decline. So that is also another indirect validation of the state of the income and the balance sheets of the Indian households. Therefore, consumption should be well supported going into 26-27 financial year.
Isn't it true, though, that household consumption would depend on where the rupee goes from here? After all, we have oil, fertilizers, edible oil, raw materials. They're all priced in USD. And with the Indian rupee in the doldrums, household consumption may get impacted.
No, not really, because we have done our homework and we covered it in the economic survey published earlier this year in January. On a net basis, a weaker rupee does improve the Indian trade balance. So we have taken into consideration all the things that you mentioned. So on a net basis, taking into account the impact on exports, taking into account the impact on imported commodities, which are priced in dollars, as you pointed out, the net effect is still a positive in terms of trade balance, and that which means the extra income, everything else being equal, that may accrue to exporters does offset the import drag. And let me point out, the wholesale price index is, almost in deflationary regime at the moment, and that is because of low import prices. Oil prices have remained stable. Metal prices are generally very well behaved. So, in that sense, the underlying inflation pressures being absent in imported commodities, therefore, having a rupee weakness at this point isn't going to be a major problem, as it is a good benefit for the export sector given the global uncertainties. Therefore, all things considered, it will be at the margin a positive reinforcement to consumption story rather than being a drag.
So, from all of that, is it fair to assume that you're not too concerned about rupee weakness right now? It is hovering at close to record lows.
Look, I mean, the rupee weakness reflects the fact that, as you pointed out at the beginning of the conversation, that investors are kind of sitting out at this moment, and therefore the rupee is undershooting its economic fundamentals. If you look at the macroeconomic dashboard, whether it is economic growth or inflation, external deficit, or the banking system, or the resilience of consumption, corporate profitability, you can tick all those boxes and they're all green as far as India is concerned. So clearly there are times when financial markets fixated on particular aspects, optics that they're looking for, such as the trade dispute, trade agreement conclusion, etc. And recently, the artificial intelligence boom also drives capital to particular sections of the global economy. So all these things have kind of cast a shadow on the rupee, but it is reaching a point where the rupee will be substantially undervalued relative to the economic fundamentals that India has, and that will begin to reflect in the performance of the Indian rupee in the coming years.
Right. So rupee undervalued, not reflecting fundamentals of the Indian economy. How much undervalued is it? What is fair value, Van?
Look, I mean, that is a bit difficult. I don't have numbers off the top of my head. If you look at the real effective exchange rate, I think the Indian rupee is undershooting the RBI's real effective exchange rate calculations. It has dropped, it has depreciated significantly in real effective terms against other currencies as well. So I have a feeling that the rupee could be somewhere, and I haven't done my estimate, anywhere between, you could take a very wide range between 5 to 15% undervalued in real effective terms. But as I said, I have to do my numbers on it. I'm not talking purely with respect to the US dollar. I'm talking in real effective terms.
We have the IMF weighing in on the policy that's been adopted by the RBI. It says that the RBI is guiding the currency, is not gutting the currency. What do you make of the approach taken by the RBI? Does it need to do more to support the currency, or are you happy with how it's being done right now?
Well, the central bank is doing a very good job of making sure that excess volatility is handled and addressed. The fund is entitled to its own perception based on a very short 6-month window during the observation period. And on that basis, they just calculate whether the rupee has moved in either direction above a particular percentage threshold. And if it isn't the case, they do classify the exchange rate arrangements accordingly. However, it must be noted that they have sort of upgraded and acknowledged the fact that the rupee is indeed more floating than they reckoned last year. So I think the central bank is doing a good job in terms of making sure that the currency volatility is not unduly excessive.
Given that the Fed is expected to cut rates further, that could mean a weaker dollar. Do you think that essentially will provide some support for the rupee?
That could be one of the factors, but I do believe, as I mentioned earlier, India's fundamentals themselves will begin to get reflected in the currency once the financial market and direct investors begin to see the rupee undervalued levels as an attractive entry option. That is one point. So India's domestic fundamentals will have a large influence on the rupee recovering from its undervalued levels in the coming years. But as you said, the potential for rate reductions or negative real yields and many other developments in overseas markets and economies will also act as tailwinds for the Indian rupee. They are too numerous at this point to list down here.
A lot of countries are grappling with sticky inflation, but that's not a problem in India. In fact, the RBI expects inflation in India to be at about 2% next year. Is low inflation good for the Indian economy?
I think so. I mean, obviously, we have grappled with 6 to 7% inflation annual average for the first 6 to 7 decades since independence. I think our inflation rates are converging, and it is a testimony to the fact that I pointed out earlier, Haslinda, that the cumulative and the lagged effects of the structural reforms have relieved the supply side constraint that the Indian economy used to face, which used to result in overheating, reflected in multiple dimensions. conditions: inflation, overvalued exchange rate, banking system stress, etc. And I believe that we are on a path to sort of, creating a longer time horizon during which the economy is able to grow sustainably with moderate inflation. So I think if it does create a good avenue for productivity-led growth in the coming years, and I would therefore argue on balance that Indian inflation rate converging to lower levels is a good thing for the Indian economy and reflects the structural reforms effects that we have undertaken in the last 11 years.
But in a way, it is a balancing act, right? Because, I mean, at some stage, low inflation would impact your fiscal position. It could be a reflection of weak demand. Is there a level of inflation that would make you worry because of these concerns?
Well, obviously, if we have a sustained inflation rate of, 2% or below at the consumer price level, then we will have to see. But even there, I think it all depends on multiple factors. We may be underestimating the buoyancy, the coverage of the taxpayers brought into the Indian economy through formalization, through technological interventions, etc. So there are multiple factors at work that will have implications for fiscal balances. The low inflation obviously means a boost to real incomes compared to historical averages, more disposable income, more purchasing power, and therefore that will also result in better growth in real terms, and the quality of the growth composition will therefore be higher. Therefore, it is not necessarily a given that low inflation means lower fiscal revenue mobilization, etc. There are multiple factors at work here. I wouldn't conclude on that. I wouldn't conclude that way purely because inflation is going to be significantly below historical averages.
Van, I want to take a look at recent developments to do with IndiGo, how more than 3,000 flights were cancelled on the back of developments there. Given that travel and tourism accounts for, I think, about 3% of GDP, I mean, how are you looking at developments there, and how concerned are you about what we saw recently?
Haslinda, I'm not a equity person, and I do believe, and I also heard the statement made by the chairperson of the company. I think the traffic conditions, the normalization of the availability of planes has been restored. The Ministry of Civil Aviation and DGCA are looking into it. And in a way, I think as always the case in macro situations or in similar corporate situations, a development of this nature will only mean better systems and better resilience going forward. So I think I do see the bright side of these kinds of developments, no matter how extremely stressful and difficult it has been for some of the passengers, for a lot of passengers. But I think in the long run, this would make the Indian aviation system, apart from the company itself, stronger and better for it in terms of planning, in terms of long-term thinking, etc.
I stand corrected. In fact, the Travel and Tourism Ministry accounts for about 7% of GDP. To that point, Van, I'm just wondering, how are you assessing the risk? I mean, 7% of GDP is substantial if you see continued problems in the aviation space.
No, I don't think so. I think, naturally, since the event is very recent, there is a tendency to overanalyze or amplify the impact. But as and when and it will not be easy, I agree, for the company to live down the last one week or 10 days of difficult developments. But if they are able to sustain better operations and more reliability, this will slowly fade into the background. And I think the market is growing on the back of higher purchasing power and disposable incomes. I don't see a long-term impact of this on the Indian domestic or foreign tourism into India.
Van, always a pleasure to have you on the show. Anantha Nageswaran, Indian Chief Economic Advisor there. Thank you so much for your time. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Here are some of the top stories we're following. President Trump has signaled he would oppose a Warner Brothers deal that doesn't include new ownership of CNN, creating a potential wrinkle for the bid from Netflix. The streaming giant's plan includes a spin-off of Warner's cable channels. Paramount, for its part, is trying to buy the company outright for $30 a share.
I think any deal should be guaranteed and certain that CNN is part of it, or sold separately. But I don't think the people that are running that company right now and running CNN, which is a very dishonest group of people, I don't think that should be allowed to continue.
Bloomberg has learned that Meta is working to pivot its AI focus toward a model that customers would pay to use. Sources say that a model codenamed Avocado is expected to debut sometime next spring. Mark Zuckerberg is also said to be getting personally involved in day-to-day work. The move would mark the biggest departure to date from the open source strategy the company has touted for years. Intel, AMD, and Texas Instruments are facing lawsuits accusing them of failing to keep their chips out of Russian weapons used against civilians in Ukraine. The suits allege the firms showed willful ignorance as third parties resold restricted semiconductors to Russia, powering drones and missiles in violation of U.S. sanctions. They also claim components were diverted to Russia and Iran. And before we go, here's a look at our guests next week. JP Morgan, or rather tomorrow, JP Morgan Asset Management joins us to discuss their global market strategy. UBS Global Wealth Management will be unpacking Asia market sentiment as traders digest the implications of the Fed's rate cut. And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.